Hey, greetings, everyone. Happy pre-FOMC day. It's Samantha LaDuc, founder of LaDucTrading.com. And I'm joined by our macro advisor, Craig Shapiro, for our macro advisor EDGE product for clients. And we're here to discuss all things macro and how we can operationalize that into some micro actionable kind of trading strategies. And how are you today, Craig?
I'm doing well. How's it going?
You sound great. And love your new profile picture.
Thank you.
I'm coming off, as you know, a little break last week. My daughter was visiting from Zurich. We did a whole bunch of traveling, literally from Georgia to Lake Placid.
Nice. Very nice. Very nice.
And New York City in between. So it was what you'd call a whirlwind. So I'm playing a little bit of catch up, but obviously all eyes on Fed Day tomorrow. And then, of course, this momentum rally that you and I have really been sizing up and timing since the beginning of January. I called it kind of the January effect, where a lot of the oversold, left for dead, high IV, high beta, bankruptcy risk plays would start to percolate up off the bottom, whether it be post-tax loss selling and then just that kind of oversold rally for January. But it is definitely now converted many a bear into a bull position. So we're going to talk about that a little bit to see, what has changed in 1 month, literally, since this market started to stabilize around January 5th. But even before that, back in mid-October, we had a whole bunch of intervention, whether it was the Fed whisperer at Nick Tamaros from the Wall Street Journal, floating that article by the Fed that they would consider a pause, to the Bank of Japan intervention of size to support their bond market on October 21st, which definitely continued the bullish sentiment, including and not limited to a US dollar swap that the Fed did with the Swiss National Bank to the tune of 18 billion. So we had a whole bunch of macro kind of congruence of events in mid-October that I think put a bid in the creation of a short-term bear market rally. And then it further got supported, obviously, by the January effect. So we have a momentum rally of size. And I have kind of shared that picture, which to me is the most important one. Let me just show you this screen for those who are interested in why it really, hold on, let me share this, really matters to risk assets that we have rotation, and why it may not benefit to get so excited until you and I can kind of talk through the macro implications of tomorrow's FOMC and earnings and recent economic data. So I think I just shared this. Yes, I did. All right. So this was just, I want to get this kind of out of the way. I'm going to ask you a whole bunch of questions and share lots of your thoughts and reflections on assets right now, risk reward, fixed income, credit markets, obviously the Fed expected moves this year. But this is the chart I really just wanted to start off with from a micro standpoint, right? This is my version. I have several of growth to value rotation and how we triggered right here on January 4th. Actually, volume started coming in. We had a big spike on Friday, January 6th, and then the rest, as they say, is history. And then just yesterday, because this was actually taken this morning, but it's a kind of an end of day value, it basically tagged a little bit of this trend line and pulled back, and I'm expecting a bigger test of this daily trend line before we get a real test of the strength of this momentum thrust off the January lows. So what's your thinking on this recent rally that we've had since January, but also mid-October?
Yeah, I mean, I would say just thinking about this rally since, mid-October, I think the biggest, driver of this has been the dollar. And I know you pointed this out, with the BOJ stuff in the middle of October, and, there was an IMF meeting in DC in the middle of October where, I don't know if we're going to look back and say that was some sort of, Washington Accord or something to weaken the dollar, but in hindsight, it sure looks like it. I mean, the DXY has moved about 11% since the middle of October. So you're talking about, close to 40% annualized move here. And I think you've coined the phrase, the dollar makes the weather, or something like that. And I think that really helped loosen financial conditions. It's helped bring down some of the inflation overseas, and it's brought back a bit into the duration of the treasury market, and we've kind of created a little bit of this virtuous circle where the yield curve flattening and inversion has led long end yields lower, which has allowed multiples to expand in the US, even though earnings are not getting better. And we've kind of created this drastic loosening of financial conditions on a Fed pause and the coming of Fed rate cuts later this year on soft data. And I don't know, to me it all sounds like the market front running the front run of the front run in a lot of ways, really getting out way ahead of what the Fed has said it is going to do, which was further discussed at the December meeting, and the raising of the dot plot, the terminal rates, and then reiterated in the minutes in early January, where they discussed an unwanted easing of financial conditions. But the market is doing what the market does, and is basically calling BS on the Fed's ability or desire or whatever to tighten further to address inflation. So here we are. I guess I'm not entirely surprised that that crypto has rallied, and that shitcoins, for lack of a better word, have rallied, and meme stocks have rallied, all into tomorrow. And we will we will learn whether or not, or we will learn more information about whether or not Powell is actually going to be more like Volcker, or will he be more like Burns? And that's something that we've been discussing for a while. So.
And now I found it interesting that you led with the dollar. So I very quickly tweeted this, by the way, just to give some precedent, just to get some context to how sizable this move has been. The dollar index is down more than 8% over just a dozen weeks, a virtually unprecedented drop over such a short period. And this is the level at which we have moved. And my saying is, the US dollar makes the weather, and its rate of change determines its velocity. So this rate of change is very, very quick, which is basically the point that this chart shows. And interestingly, though, and obviously has given a tailwind to the bulls, right? I mean, it perfectly timed its pullback, the Dixie, with all the macro events that we've just talked about, right? So this Bank of Japan intervention, the Fed, intonated pause, on top of the SNB and other US dollar swaps, all in mid-October. That's exactly when the dollar started coming down, with yields and risk assets started getting supported. There was a lot of chop during all that economic data, CPI in particular, and the FOMC meeting back in November and then again in December. But big picture, we've just gone sideways, right? But the dollar has not. It has really sizably continued lower. So I had posted last week when I was here on Monday, I still have some levels that I've talked about for a while with clients of this seeing 98. We haven't even gotten to 101, which is kind of this. We did already take out the COVID high, the freak out, right? Risk off rotation into the dollar of 104. But we've got a little bit of consolidation here in this 101 area, and that's actually where we are now. So a lot of folks are expecting some type of bounce because it's an extended pullback and can have a ricochet effect higher. What do you think would be the trigger for a move higher in the dollar? Because right now, all it's doing is, after a long, lovely move higher, almost parabolic, into 114.75 Dixie, it actually has come all the way back down into this. It's almost 101, this trend line. You can't see it because this was a week old. Actually, this is 2 weeks old, but you get the idea. What's going to be a macro trigger for a higher dollar in your assessment?
Yeah. The other thing not mentioned, which has helped the dollar fall has been the reopening in China, or at least the narrative around the reopening in China. And so that's kind of added fuel to the fire for the dollar's weakness. But ultimately, the trigger is the Fed, and that starts tomorrow. You have a market that is not believing two things, or several things, but specifically two things. One, the terminal rate that the Fed put out in its dot plot in December had 17 of 19 officials with a 5 handle on their terminal rate. The market's kind of currently pricing in, or 5 handle meaning 5.1% or higher, because that'd be 5 to 5.25, and some people are higher. The terminal rate now, as priced by markets, are about 491, 492. So we're nearly a hike less than where the Fed's dots suggested in December. And then secondly, Powell in the conference call, or in the press conference, said not one official was looking for any rate cuts in 2023. And through some Fed comments earlier this year, Bostic had been saying, no cuts, well into 2024. And others as well have talked about no cuts into 2024. The market is pricing in close to 2 cuts this year and 6 cuts between now and the end of 2024. So the market has run far ahead of what the Fed said it is most likely to do only 6 weeks ago. And the reason for that is because we continue to see a deterioration in the data, both on the inflation side and on the employment side. But that deceleration or deterioration of data is still coming from levels that are so well above kind of Fed mandate that I think the market has taken that data deterioration, way too far. I mean, the fall in inflation expected, we're still looking for, in the January prints, the headline CPI is going to be 6%, core PCE just printed 5%. I mean, these are not 2% readings. The ECI, which is the employment compensation index that came out this morning, which had been well flagged by the Fed as a trigger for some momentum on the labor front, came in at 1%, which is 4% annualized. That's not 2%. That's not consistent with 2% inflation. So yes, the data on the inflation side is getting better, but we are still far away from getting to the 2% mandate. And what the Fed has said is they need to see a slowdown in the labor market. They need to see more job cuts, a pickup in the unemployment rate towards 4.5% this year in order to see that inflation come down towards 2%. I just don't think we've seen enough data on that front yet. It's likely that we will get there, but we're not there yet. So I think the question that the market is basically saying, well, we're going to get there. We're not going to get there yet. Doesn't matter. We're going to get there. Let's price it in now. And I think the Fed's view is we need to continue to be tight in order to create the conditions necessary to get there. And so I think tomorrow you will get some pushback from Powell on market pricing. There will be some discussion about how financial conditions have been easing materially, but it's a tough narrative. It's a tough game for him because he's not going to go 50. He's going to go 25. It's not going to be easy for him to convince the market that he's serious. So, we'll have to see how he does it. There may be some subtle changes in the statement. There certainly will be some Q&A about it. I expect him to try to be resolute in his seriousness about making sure that inflation is stomped out and that just because we have a step down doesn't mean we're finished. But the market believes that there's an increasing odds that they're done after this hike and that they won't be hiking in March. So I think that's something that he needs to reconcile.
So you think that they will follow through with what the market seems to be pricing in, or they will not, and market will be disappointed?
I think the market will be disappointed. I think that he will speak hawkishly in a way to push back against the market's pricing on both the terminal rate and on the duration that it will stay at terminal. So I would expect to see some language from him, which discusses, which pushes the terminal rate back towards 5% or above. That would be aided by a strong labor print on Friday, which, is very important. I think if we were to just get a strong labor print, both on the payroll creation and on the wage front, that would add credence to this idea that the Fed is going to be higher for longer. So that, I think that 1-2 combination could really push the terminal rate back above 5%. And then as far as duration is concerned, I think he will speak to this idea that as of the last summary of economic projections last meeting, no Fed members were expecting any rate cuts this year. I think he'll reiterate that. And I think he'll reiterate that despite the data that we have seen to start the year, he'll say that's, this is expected and we still expect no rate cuts this year. So that'll be a way to push back. I think if he were to do both of those things, the market would be disappointed. The curve would uninvert a little bit. The dollar would rally. And given the high correlations of the dollar with every other financial asset that we've seen, whether it be gold or Bitcoin or meme stocks or anything that has been driven by this improved liquidity from a weakening dollar, I think that would all start to reverse, upon that. Now, we still have to get through earnings. We still have to get through that data point on the payroll. We still have to get through CPI in 2 weeks. So there's consistent data that comes, but I think that would be the message, after tomorrow.
All right, I have a chart I want to show because it kind of a little apps. Let's see if I've got this right one. I do have the right one. All right, so I have just a wonky kind of way of saying the Fed is trapped. It is similar, I think, to what you described from a macro standpoint, and you have some charts that you want me to bring up, and I definitely want to do that so we can talk through those. This is kind of a funky intermarket analysis chart that I did, and I've tracked over the years, literally decades. I started posting this in the last year where we had basically overshot. So this trend line basically of when, rate hiking cycles end, traditionally anyway, back in April 1995 and June 2000, July 2006. This is just the formula that I use, but basically also this August 2020 bonds are done going up call. We actually broke below this major trend line. And I kind of euphemistically said, Fed is trapped. Maybe down here they try to pivot, but right now all we've done is overshot or over tightened and kind of moved back in. So Fed is trapped from this standpoint is kind of an intermarket read for me, but from a macro standpoint, it's more akin to this inflation falling recently has really ignited the animal spirits, right? So the market is very excited about deflation. And, earnings expectations have been obviously ratcheted down so they can step over very easily. But there's not pricing in an economic recession, just kind of a short-term EPS recession. So right now, inflation falling is helping the market bid up equities in this flight to momentum, because Fed will actually step down, pause, and then cut. My assessment is a little bit different. This whole financial conditions of being, I would say, loosened dramatically since October, since they align very, very closely with market returns, interestingly enough, has actually created more demand side inflation. Wages are still firm, even if their rate of ascent is slowing. Housing is still quite sticky. We saw pending home sales very strong. Yes, we had durable goods inflation fall, but services inflation, largely wages, has been very, very strong. Unemployment, very, very low. Unemployment claims falling, not rising. All the things that you've highlighted. So to me, the very fact that inflation has fallen is giving this, the bull market a chance to obviously support the Fed's soft landing basis. But wages still are the reason for the season. You've talked about this, and I've written about this, right? Since October of 2021, wages over productivity gains are going to be the enemy of bonds, and they're still above productivity gains. They're also not the prices that corporations are passing on to the consumer are being absorbed. So right now you can see it in earnings. This to me is just keeping the whole inflation story well bid. At what point do you think the conversation would turn from, okay, Fed isn't going to cut this year. We actually have an inflation strength underneath the surface structurally that will create a narrative of it's time for the Fed to hike again. So again, Fed is trapped as far as I can see. Whatever they don't do at tomorrow's meeting and in March will actually trigger that fear that they've gotten way ahead and we're going to actually start to pivot higher. But I think that's probably another quarter to go.
Yeah, I mean, stepping back, I think, and I kind of tweeted about this earlier, and I've spoken about this at length, but I think the Fed is in this vol dampening business. I think what they're trying to do is they're trying to keep, kind of broad-based volatility or financial conditions within a range that allows them time to see the data come through as they expect. And in this case, meaning the time to bring down inflation back down to 2% without seeing inflation expectations rise, too aggressively or become unanchored. So what I mean by that is when they were on a path towards, tightening aggressively, going from 25 to 50 to 75, into Fed meetings where vol was incredibly elevated, or into speeches where volatility was elevated, Powell would say something or speak, or Brainerd or somebody would come out to say something to kind of dampen down the expectations of over tightening. And they did that because while they're trying to achieve, the slowdown of inflation and return to mandate, they also don't want to tank the economy and tank asset prices and destroy the government balance sheet and the like. So if vol gets too high, they speak, they bring it down. But similarly, when financial conditions loosen too aggressively, it's possible that could lead to a reacceleration of inflation expectations. The dollar falls, animal spirits come back, inflation expectations rise, commodity prices rise, like we've seen to start the year. Gasoline's up, oil's up, sugar's up, ags are up, lumber's up. So we've created a situation where inflation expectations have started to rise again. And when that happens, the Fed needs to come back in and kind of reintroduce volatility to the market in order to prevent those animal spirits from getting out of control. So broadly speaking, in my view, the Fed is a buyer of vol when the VIX is under 20, and they're a seller of vol when the VIX is over 30. So what we've had went up until, let's say, 2 weeks ago, financial conditions had loosened mightily, but inflation expectations were not rising. But over the last couple of weeks, inflation expectations have started to rise again. And I think for the Fed, that's a problem. So I think I gave you that chart. Maybe not, but I could.
This one?
There was a US five-year inflation.
This one is the
that's financial.
Bloomberg.
That's financial conditions index.
Here it is. Yeah, 5 years. Is this correlated with gasoline prices? Correct.
No, that's just the gasoline. Sorry.
Okay.
I think
bring them all up.
I'm just gonna send it.
Here it is. Yes.
Yep.
Okay.
So I mean, it's a busy chart, but if if you see there's a down the middle of December there towards the last meeting, it kind of got down very close to 2%, and then even more recently in the middle of January, again kind of down nearly towards 2%. But since, let's say, the middle of January toward up until at least 2 days ago, it had kind of moved 25 basis points higher, which is a lot. I mean, this is again, it's a busy chart, but what I'm saying is when it gets down towards 2%, that's risk of the market kind of not believing, stepping back. When that gets down towards 2%, that's them saying, okay, that mission has been accomplished. But when that starts to rise again, then there's this concern that inflation expectations can move back higher again. So I think they're kind of preventing against both. They're preventing against a deflationary bust. They're preventing against inflation expectations rising too far out of control. So I think for tomorrow, it's another buying time event. But this time it's different in that they need to take volatility back up now in order to buy time, because they don't want inflation expectations to re-engage. And if you look at
that was my point. I mean, the loosening of financial conditions is basically going to trigger demand side inflation. I mean, whether it be in the falling, 30-year mortgage rate, and it's already spurring, buyers to step back in faster. It's definitely showing their hand that inflation can lumber. We've, talked about as an oversold asset popping up with lots of other meme stocks. But the point is, it's actually a major tell that there's also commodity strength in the past few months, for sure, since financial conditions have eased, which is all going to trigger this inflationary, worry again. So again, I agree that they're more hawkish than dovish come tomorrow, but big picture, this whole year, it's going to be a dance wherein I think they're just trapped as it relates to if they do too much and inflation falls, expectations fall too fast, then they come back in and, try and prop it up, and then the reverse happens. It gets out of control on the other side, not out of control, but it's basically like the pendulum swinging both ways. It's going to be a dance this year of basically biding your time on short covering rallies, whether it be growth or value. It doesn't really matter. I think it's going to be a snake-like event all year.
Yeah, and I sent that. That's why I sent that gasoline chart over. I mean, you can see gasoline is kind of the biggest driver of headline inflation changes. And so gasoline had been up kind of 17 days in a row. It was a little bit flat over the weekend. And you can see there on the far left side here, the light blue bar is where 2023 gasoline is. The green bar is 2022. So you could already see we're at prices that are higher year on year. This actually is a 15-year high for gasoline prices for this time of year. So, look, last year we had these big spikes because of the Ukraine war. I'm not suggesting that we're going to see a similar spikes, although it's, the Ukraine stuff has kind of fallen off the table. We'll see what happens there. But we're already, because of this, getting pressure on the headline inflation front again. The Cleveland Fed nowcast has put out a forecast for January headline inflation at 0.63. It was negative last month. So again, you're talking about, it was negative in December. It's reaccelerating to 0.63 in January. The market is saying, well, that doesn't matter. It's just energy. So let's, the Fed's not going to care about it. I would argue the Fed is looking at it's looking holistically at inflation. It'll be very difficult for them to kind of signal a success if commodity prices are rising once again, food prices are rising. I mean, there's these stories about egg prices. I know they were kind of ridiculous, but food and energy is what people buy. And so it's going to be hard for the Fed to declare victory on inflation when if and when commodity prices are reaccelerating. And part of what will reaccelerate them would be a further weakening of the dollar. So I think tomorrow, some hawkish pushback, the dollar finds its sea legs, starts to rally again, a kind of counter trend bounce here. I think risk asset prices don't like that and, correct. And then we'll see how the data progresses. If the labor data on Friday is terrible, right, then people will say, okay, the Fed was wrong. They're definitely going to pivot. And the Fed may say, yep, we were wrong. Or if the inflation print in 10 days from now, again, is very weak and the Cleveland Fed forecast was wrong, then the market will go back to this pricing narrative. But I think the Fed tomorrow wants to push back and kind of reset the bar to let the data, play out.
All right. So we're definitely in agreement. I had asked you also if you thought Powell would do anything about tightening the financial conditions through increasing QT. And you said no.
Yeah, like I don't suspect that they're going to up the pace of QT, but there have been comments recently from some Fed officials kind of discussing the optimal level of reserves. And some market participants had been concerned that reserves were falling, and that picture there is net liquidity. So that's not just reserves, but that reserves have been falling so rapidly that by the middle of this year, they would breach 3 trillion in reserves, and that would be an issue. And the Fed's not trying to create that banking issue. And what Waller and Lori Logan and a couple of others have said is actually you need to be thinking about bank reserves as reserves plus cash available in the reverse repo facility, because if banks are looking for reserves, they could pay up and buy them and not buy them, but attract them by taking the money out of the RRP. So what that signals is that it's likely the Fed is going to continue with QT, throughout all of 2023. And they've also said that in a theoretical environment where the Fed is actually cutting rates, they can continue doing QT, which is something that the market had not expected. I don't believe people thought it was possible that when the Fed is cutting rates, they also could be doing QT, because there's a little bit of inconsistency there about stimulating the economy versus contracting liquidity. But what they're saying, and I think Powell may speak to this tomorrow, is that it is possible for them to be cutting rates in the future, but also continuing to do QT, because QT is a search for the optimal level of reserves in the financial system. And right now, there's way too many when you combine what's on bank balance sheets and what is in the RRP. And so the Fed wants to see the collective of those continue to fall to a point, and I think Waller had said kind of low double-digit percentages of GDP. So, we could be talking about another $1.5 trillion to $2 trillion of balance sheet reduction, over this year and into next year, which I think, based on my framework about Fed liquidity being the mother's milk of risk asset pricing, I think that is a headwind. And that chart you have there, the net liquidity chart, in that environment, you'd see that white line continue to fall. And as the white line, the net liquidity line is falling, it's harder for the S&P and for risk assets to continue their upward ascent. One of the things that had helped the white line and had added liquidity had been the Treasury drawing down its cash at the Fed, kind of because of this whole debt ceiling saga. That is something that will continue into the next few months here as the Treasury and Congress are dealing with the debt ceiling debate. Treasury has actually added $200 billion back to the Treasury general account over the last 2 weeks. So they've drained liquidity in that regard. Tomorrow morning at 8:30, we get some more information from the Treasury Borrowing Committee that'll give some insight onto how they expect to issue bills and bonds in the next 6 weeks. So that there could be some insight there. But
and you talked to this chart, which, by the way, is only updated on Thursday through TradingView. So it is not real time, just to kind of clarify. But Fred balance sheet overlaid with SPY.
Yeah, I mean, that chart is very similar to the chart that you showed before. There's really not much of a difference there. The difference is that, like, to your point, this chart that you have is just the Fed balance sheet versus the S&P. What my chart is, it kind of tries to parse out some of the moving pieces, and others are doing this as well. It kind of parses out the reverse repo, which moves daily, and Treasury general account, which also moves daily, with a 1-day lag, where you get the data. So it's what I'm looking at is a little bit more real time. I don't think you can trade this correlation on a daily basis, but I think you can have a sense of how much liquidity is being added or contracted over, let's say, the coming 2 to 4 weeks, and whether or not that's going to be bullish or bearish for risk, broadly speaking, and maybe use that as a bias tool. And I think between now and the next 2 weeks, you're going to continue to have liquidity drain. And we're continuing that from a period where the S&P is already kind of disconnected from the liquidity drain we've already seen. So I'd expect the S&P to catch down to where the liquidity is.
Okay. So I'm waiting to see if we're going to obviously hit and get rejected from this momentum rally. I can, as I mentioned, kind of coming into the week, this is where it would be most likely to pause and digest, and any late bulls to this party would be obviously, bears and bulls can both suffer, but in particular, I think this is where we're going to have a little bit of a pause. So the narrative for tomorrow is we'd be rallying strongly if it was absolutely 99% guaranteed that we would just have a 25 basis point increase and then a pause in March and a cut end of year. That's basically what the market has priced in. In the meantime, we've had a really big move higher in gold, and that gets asked a lot. Gold versus dollar, this is obviously inverted. You can see that it had been tied to the hip. I contend it's still back in that October 21st Bank of Japan intervention and all the dollar swaps, and obviously the intonation by the Fed that they would consider a pause, et cetera, and inflation expectations coming down with CPI. Anyway, it lit gold on fire, and dollar obviously has fallen strongly. What's your take on gold moving forward? Because it is a very big move, relatively speaking, in the past 3 months.
Yeah, I think gold has, some structural things that are very beneficial, which we've talked about before, which have to do with gold becoming more of a neutral reserve settlement asset as trade starts to morph away from the US dollar, specifically as China and Russia transact more for commodities away from dollar, as Saudi and China do the same, and more reserves over time will be held in gold as opposed to in US treasuries. And actually the IMF just wrote a paper about the role of gold in reserves. And so I think this is becoming more kind of known and aware, and foreign central banks in the fourth quarter, I think, had bought the most amount of gold that we've seen in quite some time. So I think there are some structural central bank flows and geopolitical dynamics that are helping the gold price. And that's why the gold price has largely disconnected from its historical correlation to real yields. Normally in a rising real rate environment, you'd see gold suffer, but this time it really hasn't. It's been rallying even though real rates have moved higher. That being said, gold is a dollar commodity also. And so I think a lot of what we've seen here in the strength of gold has just been the inverse of the dollar. As the dollar
and many commodities.
Yeah. And so I think that's been, the octane behind gold's, more cyclical move. And so to the extent that the dollar were to find a floor here on a more hawkish Fed that brought yields up, I do think gold would suffer alongside other, dollar assets and equities as well. But I think because of some of these structural issues and structural forces, it's unlikely that gold would suffer a massive correction, particularly if we were kind of moving into an environment where the US is slowing and a recession is likely. And at some point later this year, the Fed actually would be forced to be adding liquidity. I think gold would sniff that out. And so, I see gold, short term, maybe exposed on a dollar rally, but a rally to be bought on some of these more structural issues, as well as the likelihood that the Fed will eventually this year have to add back liquidity to a slowing economy.
All right, let's talk about earnings. And a few Q&A questions, especially from Hunter, because he's got a good one. But first, let me just bring up, wait a second, earnings charts. Forgive me, am I showing this right now? I am not. Let's share this chart. Yeah, so lots going on right now because we're in the meat of earnings season. We've already had, this week it's 20% of the S&P, but we've had 29% reports so far. And they have obviously revised their estimate. Analysts have revised downward at a accelerated pace in the past 6 months. We had kind of peak earnings valuation back in April and June, and it's obviously coming back down so they can step over. But in large part, we've definitely had a miss on the top and bottom line so far. And the expectation is that we are going to have the next 3 quarters of negative EPS. This is actual, this is, estimated negative EPS comps. And that's what a lot of folks are very focused on for that kind of recession worry. And yet the analysts also see a very strong move into the end of 2023 and beyond of, I think it's like 10.6% increase. So they're not seeing a recession in the economic sense, just a short-term EPS only recession. So they've really kind of just moved right past that. We've already kind of brought down the estimates, stepped over the estimates, even if the majority have kind of disappointed on top and bottom lines. The one-day reaction so far has been very positive. So they are excited about not having an economic recession and the Fed giving them Goldilocks. What's your sentiment on the earnings right now and the repricing that may be in line moving forward at the end of 2023?
Yeah, I mean, I think that hockey stick projection for earnings reacceleration is ridiculous. I don't really know how it would even really be possible to see that kind of trajectory with, first off, a very likely sizable fiscal cliff that's coming because of this debt ceiling. That will be a headwind for growth as we exit 2023 and kind of get into 2024. But also in an environment where the Fed is is going to keep rates higher for longer, it's not clear to me where the growth momentum is going to come from in order to see that kind of that earnings trajectory reaccelerate for any particular reason. And in an environment where we have a more protracted slowdown that actually brings inflation down and brings wages down, the top line is going to get, destroyed there, way more than people realize. So I don't know, the average recession sees earnings, earnings down 15%. I mean, the tightening this time around and the over earning that many of these tech companies had post-COVID, I don't know, would suggest, earnings that could be down, well north of 15%. I think Mike Wilson from Morgan was looking for, 195 for this year, but has been shying now maybe towards his more bear case, which is 180 for this year. I mean, that sounds more right to me than not. So, what's a good multiple to put on a down double-digit percentage earnings year with not clear where you get the bump in 2024 yet either. So I don't know. I mean,
they have a 10.5% increase in earnings growth for 2024. But first we have, obviously I'm showing you kind of my view of earnings, which helps stay in the trend, if nothing else. This is a monthly chart of GAAP SPX, and it has, overlaid with an indicator. And when it's obviously trailing up above the indicator, we have a strong market. Once it crosses below the indicator, we do not. And we obviously have crossed over recently, and now we'll see how this quarter does. And the next, but I would not be surprised for earnings to continue to trade, to reprice down, and the realization that the value, especially in US large caps, they just look overpriced. So if 2023 earnings do not hold up in line with the analyst expectations, which are right here, right? This is that very short duration trough, nothing deep. And then right back into very strong, or I should say moderate growth and no recession. That's not what this particular trend line tag, just even if you just kind of think, let's just come back out of COVID, right? This was clearly the COVID bump. Lots of have talked about the valuations, peak earnings. I don't even think they've been priced in yet. Look, COVID levels have been priced in yet.
I think you can, as I'm just looking at your chart here, man, I think you can even, look at the periods of time that you spend between the red line and, under the red line, let's say, maybe you need another red line that runs parallel, but is under that red line to catch some of the older ones. But under that band, let's say, is when companies are under earning. And over that band is when companies are over earning.
There you go.
So, you basically have these, cyclical periods where, earnings are under earning versus normal. And then you move into over earning versus normal. And I think what you see here is you have a period in, let's say second half of 2020 and early part of 2021, where you have a sizable shock that leads to a quick under earning period for the economy. And then you have a rapid reacceleration of earnings growth. And now you're into, 8 quarters now, or whatever that number is, let's say, or 6 to 8 quarters of over earning. So to believe that we're going to structurally over earn this trend, which I bet you if you, line up that trend and look at a, nominal GDP plus some buybacks, you're talking about kind of a, secular trend of, mid-single digit earnings growth. That's your long-term earnings trend for America Inc. And when you're earning 30, 40, 50% above that trend, you can only do that for so long. More capacity comes in, inflation comes in, rates get hiked. So a retest of that line seems, very, very likely. It's probably, you could even argue we should go under that line for a bit, but let's say we at least get back to that line. And
That's all I'm
talking about,
saying.
yeah,
Let's
exactly.
retest the breakout.
Right. So
and
it's very hard to, say that while that line is falling back, while that yellow line is falling back to red, that should be a period of substantial multiple expansion. So, particularly when inflation is still running above normal. So that to me is a major headwind for equity valuations for the rest of this year.
But that is not what the market is pricing in. So Steve Mann makes a mention that the irony of the chart being labeled GAAP SPX, does GAAP GAAP still exist in reported earnings? I don't know what percentage of companies do report, but this is mathematically, this has been working extremely well for many years. So I've used this really, really well. I haven't had to parse out. It just works. So I'm going to say that even if it's not as popular anymore, it's still reflected in the indicator. So I'm going with it. But the question also in Q&A, I want to kind of go over some of those questions. The question of what's the trigger in mid-March. Bank of Japan. So Bank of Japan came out and did their massive, support of their bond market in October 21, and then they basically doubled their yield curve in early December. So all of this has been fabulously bearish for the dollar and bullish for risk assets, and bearish also for U.S. yields. So combine that with the fact that Kuroda is leaving. I don't expect any changes at his last meeting, which I think is around March 10th, but I am expecting the March 20th report, which is inflation, especially around wages in Japan, to be market moving. That's what I'm looking for. I've been watching, Asian inflation prints and Australia, and oh my gosh, they're red hot. I mean, they're just really still red hot. There's been no tempering of that trend. So I think that's when we're going to have some move in the dollar yen carry trade. And as a result, I think we could digest here in dollar and yields for a while, actually, until we get to that March. We also have FOMC, right? Potential disappointment, but we also have the Bank of Japan 20th. So and I also just think that some of these charts need some time to set up. I just don't think it's it's an immediate reversion to a mean type of trade. I think these charts need some time to set up and basically chase out both bulls and bears. So no, I understand your question. I've been asked that before, Steve, so don't worry. All right, so Hunter has also some questions, and I don't know if you can see it in Q&A, Craig, but he's referring to thoughts of inflation resurgence, sugar, iron ore, aluminum, gasoline, lumber, as a result of the dollar dropping and the dollar yen right, pulling down very hard with the dollar yuan, which is the reason for the season for a lot of the commodities. Despite the tech layoffs, they're not as big a component of general payrolls, and construction layoffs have not occurred yet. So there's still a lot of backlog in single family homes and also multi units, a big increase actually in 5 units and up that still has not even turned the corner. They're still red hot. So construction labor or payrolls have not been hit yet. So this is going to continue the theme of low unemployment claims until we kind of make up that backlog in the construction. So I don't see as much a concern on the tech layoffs as others. I'm more interested in construction unemployment. That's definitely my focus. But you had a question. Let's see, last GDP report. Can you see his second question, Craig?
Yep.
Okay. Can you answer that one on the GDP report?
So this thing about, there's a thought that credit card interest rates moving higher, is a material headwind for the consumer. Yes, but I would say as a percentage of disposable income, and debt, it's really not too dissimilar from where we've been in prior cycles. So I wouldn't get too up in arms about how higher interest rates, specifically are affecting the consumer on the credit card side. I would just say, broadly speaking, though, higher rates, higher inflation is affecting consumer sentiment. So I just don't think it's credit, I don't think there's a risk in the credit card debt moving higher specifically as some sort of exogenous event. But look, I think real retail sales have not been very good. And we saw that in the December print that came out, a couple of weeks ago. And I suspect we'll see similar levels of sluggishness out of the consumer from a real perspective, here again in January and February. I mean, I know Visa and MasterCard and American Express had all kind of talked about a consumer that's been resilient, but I think that's more of a nominal comment than a real comment. As consumers are paying more for groceries and for other kind of essential items, maybe spending less on non-essential items, but broadly speaking, are still spending a lot because wages are up. It's just that impact and that kind of tie through to the economy and to corporate profits. I think is what's being strained. I mean, there's a sizable margin compression story, going on. I think Morgan Stanley had said that 80% of S&P subsectors now are seeing cost inflation outpace sales growth. So you're talking about kind of broad-based margin contraction for 80% of the industries, and really the industry where we're not seeing it is in energy. Right. I mean, Exxon, 56 billion of profits, or 59 billion, or some, monstrous number. That's where the profits are. But away from energy is where we are really seeing.
Yeah. If you strip the energy out, we have a wee negative print. I saw that.
Yeah.
Yeah. So that's also on the earnings compression question. I'm actually fascinated that we don't have more layoffs yet. In other words, the very first chart that I looked at the beginning of the year was UNH. So United Healthcare and the rest, they started to sell off as the momentum rally kind of picked up. So that is that rotation, right, that I kind of showcased in that first chart. But they are bloated with staff, just like tech overhired during COVID, right? Lots of money. And they put it right into tons of hiring. And now they're feeling, oops, we ate too much. we gotta purge a little bit slowly, and then it picks up a little bit later. But I'm really surprised we haven't heard of more layoffs in the healthcare space, because that's a big factor for earnings compression. But otherwise, the prices have been pushed through, right? They are, you've heard of shrinkflation, so they might have smaller goods that they're selling at higher prices, but people are buying it. You've heard of, the volume. They might be buying fewer items, but they're still paying the higher prices. So far, the major earnings compression, I don't think has really kicked in. Once we see it in industrials, once we see more layoffs in healthcare, and then of course, construction is a major tell, but by then it's too late. By the time we see it in construction, it's done. We're already in the recession, like deep. So. All right, what other question was, and speaking of home builders, I'm actually, right now, they are sticky, like wages and backlogs and money that is still in the system. Even if the yields, the 30-year was 7% and the risk of the mortgage rate lock, which just meant that those who could sell wouldn't, and those who could, like investors, we're obviously going to have to reflect market conditions, which were softer. So we're definitely coming back and repricing those very high premiums on houses in certain areas, but it's so region specific, and there's still so much backlog to work through that I think it's actually things over paper, which has been my theme, right, since that kind of March 2020, summer 2020, I should say, is still viable in housing. I'm not seeing the same risk to the housing market because inflation is staying sticky. That I think other analysts are very fearful that we're going to have a housing crash. I don't see that. I can see risk of recession for sure. Let's see what happens with Bank of Japan, with debt ceiling. Who knows? Geopolitical. Those are black swans. I can't even comment on. But as it relates to payrolls right now, we're nowhere near my trigger of 267,000 unemployment claims. We're at 180,000. So until we start ticking up and have a trigger for ticking up higher in unemployment claims, housing is going to stay bid, and the Fed is going to have a tougher time of basically getting wage inflation under control. And I just think that's it in a nutshell.
Yep.
All right, you had another, I don't know if you saw his other question.
Well, I see another question here just about the setup for the Fed meeting and the rest of this week. And I did want to bring something up because I think it's worth discussing. But last Friday, I know you weren't, I don't think you were in front of your screen, but we had, when you had the Tesla reported after the close on Thursday. So Friday became a 0 day for expiry option day for Tesla, right? Because so what you saw was just a tremendous amount. I mean, almost not that it was a record, but it was millions and millions, kind of more than we've seen in months of call buying for Tesla. And clearly Tesla is a poster child for risk taking. It's it kind of has, its weight in the Qs and in S&P. And so it kind of created this gamma effect that drove S&P higher. And then I think what we saw on yesterday was just that once that came off the tape, the market kind of reset on Monday. What you have on Friday, I think, is going to put this Friday coming up is going to put last Friday to shame. I mean, what could happen this Friday is going to has the potential to be like record option 0 day to expiry option volume, because you have Amazon, Apple, and Google all reporting after the close on Thursday, which turns Friday into a 0 day for expiry trading day for all those securities. Plus you have the employment number in the morning, plus the follow-on from the Fed. So you're going to have just an extraordinary amount of notional transaction volume and notional dollars of exposure being traded, all day on Friday. I mean, the thing about 0 day to expiry, and I'm certainly not an expert, on this, but basically, if you're trading 0 day for expiry, you don't have to post margin for that. With that clearinghouse, it's literally you do it.
That's a really important point.
The hell you want. So
because so many people are crediting the 0 DTE as a retail phenomenon. It's hedge funds They don't have to post margin. They can get around it. They're cowboys and cowgirls right now.
It's institutional players that you don't have to post collateral. It's basically, it's free money. And so,
Yep.
we are in a situation for Friday where you just have an extra, I don't know, it could just be an epic thing. And I'm kind of thinking back to, end of January, early February of 2018, where you had that vol event. It just strikes me like the setup is there for, something similar possibly happening, where there's, let's say if there's bad news, there's a hawkish Fed, there's a constructive employment print and some bad earnings, and all of a sudden you have, put buying and dealers dynamically hedging and selling and selling and selling. And then, it could just be a wild thing where a dealer is caught off sides or whatever. So I'm just keeping an eye on Friday from a volume perspective and a vol perspective, just to, are we staring at something here that's massive? And if you look back to the 2018 analog, it was a very similar setup where you had a Fed meeting on a Wednesday, you had the big three report earnings on Thursday, and then vol started to creep up on the Friday, and then Monday was the biggest notional, point down day, I think, in the history of the market. We were down 1,100 points or something. So I don't know. It's just one of those things to kind of keep in mind.
All right. Well, I hadn't thought of it that way at all. But again, I'm in re-entry mode. I will say that so far I see no market net selling. So one of the big deals that I do for clients is I track breadth and volume extremely closely, like hourly, to identify when conditions are ripe for going long and short, and pressing long and pressing short. And so far, since Wednesday, the 4th of January, we have had just buying, net buying, and solid breadth. So I had said last Friday, I did come back, for one day and did 2 interviews. And I said in both, I still think this is a fake breakout fast failure, but we haven't turned yet. The closest I have is that chart that I showed you of the momentum thrust right into resistance. I am still very bearish this year for one more leg down in tech. And I definitely know that that is not consensus. I think there are like 2 analysts out there that have kind of that see lower, but I also absolutely respect that this risk profile is increasing for volatility. The problem is timing it on, like you just said, this kind of perfect storm of earnings with payroll, with FOMC, but it just doesn't have, for me anyway, a sold to you market feel yet. And I can usually see the distribution under the surface before the selling starts. It's called the divergence. I can see very, very clearly that breadth is way the heck up here, price is here. There is a huge disconnect. So that alone is a major divergence, no question. And then I was asked about TLT. I'll show that real quick, but there was the volatility chart that I also wanted to show that I'm expecting this year, but we're not there yet. Hold on, let me bring this up because I know we're also 5. Gotta find it first. You know what I'm talking about, which is basically this year will have some, it has characteristics for sure for some outsized volatility. Right now, I'm not seeing the timing from a macro standpoint until March. I do see something happening very, very soon in oil and bonds. There will be a big inflection move in oil and yields, put it that way. And usually dollar goes long for the ride. But yeah, I'm not finding that chart. So I have shown it to clients, so I know that I have it here somewhere. Anyway, suffice it to say, this is going to be a year where, there it is. Open, share. All right, where I mentioned this a month ago, that this is definitely, we're coming into a period where volatility starts to get very, very busy and erratic as this indicator basically flattens out. So as long as this ratio is below this indicator, it is a bull market, baby. But as soon as it starts to get above and below, it is a coiled spring ready for some type of big move. So I am definitely of the opinion that we will have volatility. Timing it is another thing. I am also of the opinion that this is more akin to 2001 or 2008. We have not had our last kind of hurrah lower. That's me. That's my assessment. This just happens to be kind of an example of the 2000, 2002. This is, the same thing, 2008 to 2010. So we're in it. I mean, we're definitely in a bear market. There's no question in my mind. And anything right now that we are having, such as this most recent rotation off the January 5th low, is simply a bear market rally. So as it relates to yields and dollar, I still see some chopping sideways with oil for that matter, with the exception that I'm expecting a sharp move in the next 2 weeks for both oil and bonds. And I will share that detail with clients. And we want to invite you anytime you want to kind of pop in. I run a fishing club. We're going to close it here because it's already after 5. I run the fishing club product for LaDucTrading, and macro advisor is post only in Slack that Craig contributes his interpretation of what's coming down the pike in the macro and economic data. And he also is concierge service for Edge clients and sharing his entire book and also active trade support in addition to research around events. So we have it going on from macro to micro, running a live trading room. I am going to be doing a live FOMC tomorrow just for giggles. I don't always do a live trading room for the public. I always have the morning session for clients. And when I was out last week, I had 3 of my live trading room moderators sit in, and they did a great job. I got some really positive feedback. So I've got a great crew, great deep trading desk also of 9 contributors. So we invite you to check it out. And this will be recorded. The last one, I goofed, didn't get it recorded. My fault. You had to be here to benefit. And you would have seen this chart, for example. But the point is, this one will be recorded. We'll load it to our YouTube channel. And any parting thoughts, Craig, before I close? Because I just realized we're 5:10 Eastern.
No, look, I mean, I think we now, I think we covered a lot of ground. I think the next 72 hours between the Fed, the ECB, employment print, and big 3 tech reporting, where this is I guess a financial market Super Bowl, for lack of a better term. I think that we'll really get a sense now of, the next direction. Clearly coming into the year, the markets have been euphoric on, an easing of financial conditions, covering from last year, just, new money, new year. But now is where the rubber hits the road. We really need to, kind of see how the Fed is going to play this out with the data. And, my view, the framework revolves around kind of timeline towards Fed adding liquidity or contracting liquidity. And the market has been pricing in an adding of liquidity. And I think they're going to push back against that in a way. And so, the next few weeks are going to be, I think are going to be highly challenging, for risk assets on back of this. So.
Yeah, and you're not alone in that, by the way. I have to, just since you mentioned this, I saw today, in fact, that we have some other outliers here, a very rare signal, in fact. This is a Morgan Stanley chart that global risk demand index has risen sharply, and it's nearing a 3 sigma move, very much similar to what happened in August before we peaked and rolled over. We have lots of concern on some economic data, but that's not enough to kind of get so much selling per se. But I was recently also looking at the CTA levels. If I could find it, I would tell you. Here it is. So if we do have some selling, a down tape, right? The CTAs, which are kind of those automated funds that just kind of buy and sell based on technical levels. A down tape, sellers would have 183 billion to sell. If we have an up tape, they only have 49 billion to buy. So there's definitely more risk than reward should we come into turbulent waters come February. And last but not least, the fundamental long short hedge funds have increased positioning close to 1 year, all in extremes. So basically, this is a Goldman report that says they are at gross leverage at 183.4%, which is a 99th percentile, and net leverage is in the 73rd percentile. So we definitely have some exuberance that is manifest in the numbers that I just showed you, but we also have some risk of selling should there be any disappointment. And that's basically the point. Are we priced to perfection on both Fed and earnings? And I think you and I are both in agreement that that'd be a yes.
Yep.
All right, everyone, thank you so much for joining. We'll upload this on the YouTube channel, tomorrow, the next day, whatever. All right, cheers. Bye.
Right.